Thank you for joining us for today's S&P Capital IQ webinar. We want this to be an interactive session, so please feel free to submit questions online throughout the presentation, and we will answer as many as time permits. Before we get started, we would like for you to get familiar with our platform. Along the bottom of your screen, you'll see some icons that may be new to you. Let's take a minute to learn about these widgets. Starting from the right, you will notice the S&P Capital IQ website icon. Click here to go to our website. Email a friend is the next icon. Invite anyone who may enjoy this webinar. Next is the resource list icon. Here you will find all related articles and documents, including today's presentation deck. Then the Contact Us icon. Have a question? Ask us. Our survey icon is the next one, and your opinion is very important to us. Please fill out the survey after the conclusion of the webinar. You can also share this webinar using the Share This icon. Please feel free to share by clicking on any social networking app like Facebook or Twitter. Learn about the speakers for today's session just by clicking the Speaker Bio icon. The Q&A icon is where you can submit your questions during the webinar, and we will answer as many as time permits. Next is the Media Player icon. Here you will find audio volume control. The next icon is Slides, which is currently showing this video and will show the presentation slides next. And last but not least, the Help icon. In the event you experience any problems viewing or listening to this event, click here. Now let's start the webinar.
Hello everyone, and welcome to today's webinar. My name is Thomas Jaegel, and I am the Vice President for Credit Market Development at S&P Capital IQ. My role includes leading market development activities across the firm's market segments, writing and delivering thought leadership, and helping our commercial team with key sales and outreach initiatives. It is my pleasure to moderate and present in today's webinar, Credit Conversations, Practitioner Perspectives on Challenges in Counterparty Analysis. For those of you that have joined us before, welcome back. For those participating for the first time, we host webinars to address the challenges identified by our clients or to present thought leadership on a relevant, timely topic. We will continue to host our Credit Conversations webinars focusing on credit risk assessment and management throughout the year, so stay tuned for more information on these events. Please note that the activities of S&P Capital IQ are independent and separate from Standard & Poor's rating services. You have just seen a video introducing the various widgets for the webinar. I would like to point out the survey and resource list widgets located in the bottom right of your screen. We ask you to complete the survey prior to exiting the event, as it allows us to gauge the value of our presentation and helps us to make sure that future events cover topics relevant to your needs and interest. We want this to be an interactive session, so please feel free to submit questions throughout the presentation or during the Q&A session toward the end of the webinar, and we will get to as many as possible. All participants will receive a follow-up email, which will contain an opportunity to obtain a copy of the presentation slides and the webinar replay information. We recognize that this topic is of great interest to those of you who are on today's call. We are excited to have over 1,300 registered for this event. Thank you for joining us. We're happy to have joining us today my fellow panelists, Jim Elder, Ritson Fernandez, and Tim Logan. Jim Elder is the Director of Market Development for the Corporate and Financial Institutions segment at S&P Capital IQ. Jim's role includes leading market development for corporates and financial institutions, writing and delivering thought leadership, and helping our commercial team with key sales and outreach initiatives. Ritson Fernandez is a Director in the Structured Finance Group at Cat Financial. Ritson's responsibilities include managing origination, structuring, underwriting, and documentation for metals and mining projects in the Americas. Tim Logan is the Global Portfolio Manager in the Mining Finance Group at Cat Financial. With 30 years of experience, Tim's current responsibilities include strategy, Commodity Price Forecasting and Management of the CAT Financial Global Mining Portfolio. Tim also holds an adjunct professorship at Vanderbilt University. Thank you, Jim, Ridson, and Tim, for joining us. At this time, I would like to invite Ridson to provide a brief overview of CAT Financial in order to provide our audience some context on the firm and Ridson and Tim's division. Ridson?
Thanks, Thomas. Most of you have heard of Caterpillar, and there's some quick facts about CAT Financial up on the screen. Some of that may be new regarding the number of customers that we have and the countries that CAT Financial is involved in. We'll try and hit on some specific issues throughout the conversation today. I do want to let the audience know that Tim and I work specifically in the mining finance group, so our views will be based within our experience within the resources sector. If you talk to our colleagues in other groups, for example, in our power and energy group, you would hear different feedback about their counterparty environment and how they tend to manage risk in their groups.
Thank you, Ridson. Now let's begin our discussion. Today we will cover the current counterparty environment, approaches to assess and monitor counterparties, globalization of counterparties and the impact, challenges of public and private company data, and captive finance trends in lending. Now, let's start the current counterparty environment topic with our first audience poll. As we read through the question, please fill in your response, and we will have a brief discussion about the results. When do you see the next credit cycle / downturn starting? Late 2015, 2016, 2017, 2018, or later? And we did not provide an option for never, so you have to pick one of those. All right, let's take a look at the results. So I think we have, on balance, a pretty diverse set of opinions on this topic, with most people not choosing, only 14% choosing late 2015. The rest relatively evenly divided, but a slightly optimistic audience with 31%, the largest set of respondents choosing 2018 or later. Well, with that, let's dig in some more into the topic of where we are in the current credit cycle. So what you're seeing on this screen is a chart of leveraged loan defaults as measured by our LCD Leveraged Commentary Data Group at S&P Capital IQ. And as you can see in the middle of this screen, that's the financial crisis, the big spike to up over 10% defaults, which dropped off dramatically into 2011. And we've been experiencing historically low default levels for the past several years, noting that when you include energy future holdings, that number jumps up significantly to about the long-term average of around 4%, with projected estimates in 2015 and beyond looking at potential uptick in those numbers. Now we'll take a little deeper view into this and take a look at credit levels across the sectors. In the chart on the heat map that you're seeing on your screen, a couple things to point out. First of all, what we're measuring is with S&P Capital IQ's probability of default market signal model, which is a quantitative model that relies on equity price information, and Jim Elder will be talking more about this later in the presentation. We're looking at median levels for the S&P 500 and for the S&P Europe 350 across all those sectors. What do we see? We see in general an increase in risk levels as measured by that median probability of default value throughout the year, going from, on the S&P 500, a low level of overall 0.05% 1 year forward-looking probability to the kind of turn of the year with the level actually reaching 0.14%. Also pointing out, so that's true, that trend is true for both the S&P 500 and the Europe 350. It's also very clear that energy risk levels spike up significantly. They've dropped off a bit since the turn of the year, but are still quite elevated and adding a lot of risk into the overall risk levels. With that, I'd like to give Tim Logan from Cat Financial an opportunity to respond with what he's seeing in terms of risk levels.
Thank you. Wanted to talk about this slide specifically in respect to the counterparty from a mining perspective. We've observed companies have been able to withstand a reduction in commodity prices over the short term, and they had the financial stability to withstand that short-term discussion. However, this slide shows that the longer-term systemic shift in commodity prices across mining, we've seen some pretty long-term impacts on this as the commodity prices have dropped. The slide also further shows some small price moves that help the mining sector, but the significant trend over the long haul is commodity prices are lower. And when you look at copper and you look at gold in this particular slide, you would see a very similar discussion around iron ore, coal, bauxite. All of the commodities across the curve seem to be heading in that same direction. So what we've seen is a bifurcated impact. As you can imagine, these large mines don't just come on in a month. So there's about a 3 to 5 year development glide path. As new mines are thought about and implemented, that supply now is starting to come online across the globe. And so we've seen some supply side heading upwards in the markets. And because of that, we're seeing some continued downward pressures on prices. This is in concert with the supply side. We've also seen some changes in GDPs, primarily China. Several years ago, China had about a 14-handle GDP. Depending on who you talk to now, that is about a 7-handle on GDP, which is really driving the demand side lower as well. So supply coming online while global growth has dropped has, again, seen some pipeline pressures for lower prices over the medium term. The ultimate result in this has been mining companies have experienced some damaged balance sheets as the ore body valuations are reduced. And we've also seen some income statement top-line sales dropping. As these commodity prices have dropped, these customers are not able to sell into the markets at the higher prices. So we've seen a reduced EBITDA, no PAT, but we're hoping the cyclicality of this business will start to see some upward swings coming in the near term.
Thanks, Tim. Actually, when wondering, we see this the risk levels in the counterparty environment in mining, but we also saw in the previous slide some, the effects that with the oil price decline in the energy sector. In terms of that, do you guys have you seen any changes with lower oil prices, lower energy prices?
Actually, some positives out of the oil price change is we've seen some all-in cash costs for our miners have actually gone down. As you can imagine, there's a tremendous amount of diesel fuel that's used in these large mining operations. So a drop in 20-30% oil prices, we've seen some positives for our mining customers from an all-in cash cost production side.
Thanks a lot for that perspective. Now we've kind of covered the high-level counterparty credit environment. And with that, we'll take a look in with Jim Elder on methods for assessing and monitoring counterparties. Jim?
Thanks, Thomas. So what I'd like to introduce here is something that we at S&P Capital IQ call the credit spectrum. And what we'll present is really sort of a broad framework to assessing creditworthiness across a variety of methods and approaches that allow you to cover all sorts and sizes of companies. On the left, what we've shown here, starting in blue with issuer credit ratings, is something that you're all probably fairly familiar with. Those are credit ratings from major rating agencies such as Standard & Poor's Rating Services. They are long-term views of creditworthiness, incorporating quantitative and qualitative measures, and they cover about 9,000 companies globally. Credit assessment scorecards follow a similar ratings type of approach to analysis that allow you to take that analysis in-house so that if you'd want to come up with your own assessments of, say, management and the industry alongside those quantitative financial inputs, you can follow that, and they come in particularly handy for low default sectors, such as municipals or other corporate sectors that might have a lower track record of defaults. Now, when we think about these two columns, particularly issuer credit ratings, they're not going to be available on all the companies that are rated. We see we have 9,000 companies, but practically we have a lot of exposures that are unrated. So what we do in the center of the credit spectrum is, note in teal, we have quantitative fundamental-based models. And what this does is it allows us to expand the universe of coverage of entities that we're looking at to unrated companies. We have three families of analysis. We have credit scoring models, which are calibrated to ratings, so they allow you to provide a little bit longer-term view, medium to long-term view, but they cover rated and unrated companies and allow you to have a like-for-like comparison across those two different universes. These models, in practice, have about a $25 million revenue floor, so you can't judge the really small companies. That's because they are calibrated to ratings. But you still get about nearly 40,000 companies that are covered in this method. You can also follow fundamental PD models. That's the center column. Now, these are calibrated to actual defaults, and so it's going to give you a 1-year forward-looking probability of default, up to a 5-year probability of default. They're going to allow you to cover companies of all sizes, so as long as you have the financial statements, there's no revenue floor on that, and they still perform quite well. And so the universe of companies that are covered by this model are, more than 500,000. So quite a large breadth of coverage there. And finally, we have peer group analysis, which also uses financial inputs, and it really gives you a relative comparison amongst the defined cohort of peers to kind of stack rank them based off of different creditworthiness measures. So we have qualitative and quantitative measures on the left, qualitative only models in the center. On the right, in red, we have quantitative market signal models, and the advantage of these is you're looking at live market data. So you have end-of-day equity prices, you have CDS spreads that are input into models and allow you to get really clear early warning signs of credit risk. So stock price volatility, sort of a Morton-based approach, also gives you a 1-year forward-looking probability of default out to 5 years. And it's going to be very granular in that assessment. You're going to be limited to only publicly listed companies because you need that equity price data. And there's also CDS spread models, which again allow you to go towards a credit score, much like a credit scoring model, to compare against, say, a rating on a company. The constraint on that, again, is going to be coverage, and that you need to have liquid CDS. So you're talking about 1,000, 1,100 companies that are covered. But both of these metrics will provide you with really daily signals that give you that early warning sign. So as we look across the spectrum, we have qualitative and quantitative inputs in blue, quantitative only based models in the center in teal, and market-based quantitative models in right. And really what we see is sort of best practices would indicate that you might like to try at least one model from each of these three families to cover a mix of ranges of approaches, long-term and short-term views, and really early warning signs. So with that, I'll turn it back to Thomas.
Thanks a lot, Jim. And to our audience, we will be sending out you will be able to get the slides, so you'll be able to take a look at that in detail as well. Ritson, would you also comment on the credit spectrum from Cat Financial's perspective?
Yeah, and the spectrum that you guys just put up is actually we covered the entire gamut within Cat Financial. In the beginning, that intro slide, we have over 135,000 customers, and some of which will fall into pretty much every single part of that credit spectrum. Just to give you an idea of the range and how we're looking at it, what you're looking at on the screen is actually is a picture of that machine, and you can kind of see some people standing around it, which gives you some idea of the scale. So that's a machine that could be $40,000, $50,000. Some of you guys I know there's people in the audience that have cars that are more expensive than that. But at the end of the day, those machines, we can actually just go through and use a quick credit scoring model, some of the inputs being just regular personal FICO credit scores will be part of the input there because we're looking at on the credit of the initial sole proprietorship. On the complete other end of the spectrum, and I don't know if you guys can see at the bottom right there's a person standing next to the bottom right of that shovel. That machine is 10, 11 stories high, and you're going from something that could cost $40,000 to something that can cost $40 million. And the companies that are buying fleets of this type of equipment are go on the other end of the credit spectrum. Now you're talking about companies that actually are publicly traded, so you can look at the market and signals and the CDS scores. Some of the companies that have ratings from agencies like Standard & Poor's or Moody's. And obviously the other thing for us is the exposure level is different and the risk is different. So just fundamentally, a $50,000 machine or exposure, you may let a credit scoring model do a quick auto decision process, and for $40, $50, $60 million, you're going to have the team of analysts that will be looking closely at it.
Thanks a lot, Riston. With that, having covered the credit spectrum, we will go into a topic around the globalization of counterparties. And with that, we're going to start off with a poll. Again, for the audience, please fill in the results, and we'll have a little discussion on them afterwards. Which of the following is your top challenge in analyzing counterparties? Is it analyzing the data on counterparties, the consistency of analytics, the correctness of analytics, getting data on counterparties, or the sheer number, the volume of counterparties? Let's see what our audience selects. Interesting. So at an overwhelming majority, 63.6%, it's about getting data on counterparties. And a bit later in our discussion, we'll have a conversation around the challenges with private company data, where we'll address that a lot more. But certainly the globalization of counterparties is a key aspect that makes that challenge of getting data even more complex. So with that, we'll have Tim provide his views on the globalization of counterparties from Cat Financial.
I think one of the interesting things that we're observing across the global markets here is a change in taxation levels for companies that are running mines across the globe. So as commodity prices we're seeing high levels in 2010, 11, and 12. Mines showed some significant profits, and because of those significant profits, in the normal course of governmental taxation authorities, they have engaged in some activities to improve the taxation revenues for those respective entities. But in their slower response times, new taxation schemes are met with some significant pushback by the mines in today's market versus what the taxation authorities are viewing as significant highs. So, for example, an African operation has observed an increase in the taxation scheme from a 5% to a 27% level on the royalties. This obviously changes the entire viability of the mine structure from a profitability perspective. Some countries in the Asian markets have changed not only the tax structure, but they've also required from infrastructure investment by the mines to obtain export licenses. So once the mine is started, it's almost held hostage by the taxing authorities as a way to get them to provide infrastructure for the areas around the mine, and in doing so provide some export licenses as well. So quantum changes to the cost structure for these companies in concert with drops in commodity prices have been an ongoing theme over the past year and a half.
And in terms of growing exposure to counterparties, you can what you're looking at on the screen of the charts is just our shift. That yellow is everything outside of essentially the U.S. and Canada. You can see our business has been growing in terms of the financing that we're doing, and that shift has been significant to where over the majority of our business is actually starting to be done outside of North America. So it's definitely been all the challenges that you mentioned in that poll question. I think our answer would be all of the above in general, because all of those things are things that we have to deal with. And the audience's answer about getting deep financial statements on our end, even when we do get financial statements, translating it back from French or Spanish to English is another thing that we deal with too.
Well, I mean, we all know that there are significant challenges with the globalization of counterparties, but Ritson, we've talked about this before, but I mean, with Caterpillar, you got these big yellow machines. You must never have a problem, getting the collateral back.
Yeah, well, there's a couple of things that we deal with. Even if you think about a developed, stable country like the U.S. or Canada, some of the small machines, we had a customer once that we were going to go get the collateral back, and the machine kept disappearing at night. We would see him park it, and then it would disappear. And it took a couple weeks before the team figured out that he was basically driving it under the water at night, and then when he needed to use the equipment, would start bringing it back up. And then if you talk about something like Canada, we have equipment that's within the Arctic Circle. So I had a chance to go a couple months ago to a mine site visit where our equipment is there and it's great, but 9 months out of the year, the ocean around the island is frozen, and you've got a 2-month window to come go and get it, and it's specialized equipment. So it's definitely a challenge, not only when you're talking about emerging markets and the legal structure, but even in the U.S. and Canada, getting something out of the North Pole is kind of tough.
I bet. I'm imagining you parachuting in, the first parachuting counterparty analyst. But no, that's fascinating.
I've been threatened with that by my boss, so.
Thanks a lot. And with that, we'll take it over to Jim to give an update on the globalization and issues surrounding that.
Thank you, Thomas. So here at S&P Capital IQ, in light of that credit spectrum slide that we saw earlier, when we think about models and approaches, we like to have models that are analytically consistent globally, so both within sectors and a single geography, but across multiple geographies. And country risk is something that is very important to that, and we've come up with a way to think about that. Our clients are thinking about that. So we call it a country risk framework. And really what it is, it's a method to think about encapsulating the risk of doing business in a country. When you think about country risk, you might first jump to, say, the sovereign rating for that. It's a very common way to think about risk of a country, but that really speaks to the risk of the government's ability to repay and willingness to repay its own debt. When we think about looking at companies, we want to make sure that they're comparable across the world, and a big part of that is the risk of doing business within a given country. So we look at several factors for this and coming up with a country risk score. You can see a quick summary of that at the center. So we're looking at legal systems, governmental systems, and human development issues. So corruption, strength of legal system, and sort of IP protections, political stability, all these things are very important. And to think about how it would sort of tangibly look, on the bottom you can see a table of how these might vary quite dramatically in some cases between the country risk score that we derive and the S&P rating on that country. So something like China is AA minus rated by S&P, but its country risk score is BB plus, lowercase BB plus, which is quite different just based upon sort of that business environment. On the flip side, you have a country like Portugal, which is rated BB by S&P, but its country risk score is lowercase AA minus. So it's a much more friendly business environment despite the struggles of the government itself from a ratings perspective. To take a broader look, what we've done here is taking a global snapshot, and any country that has at least 30 publicly traded equities that we're deriving into PDs. So we're scoring all the companies within a country based upon its equity-based probability of default. Here you see the median level PD of the countries that qualify for that. Color-coded, so green is lower PDs, better credit quality on median, red is worse. You can see the PD ranges that we're selecting. These ranges were purposeful in that we look at observed default rates of rated firms, and the darkest green, so that less than 0.03%, that's the typical default rate of a AA rated firm or greater. The next shade of green would be sort of a single A category. The lightest green would be BBB, and so forth, down to BB, single B, and CCC or worse. So that's a way to sort of judge the shading of the colors. You can see here that the lowest PDs You have Mauritius, which might be a little bit surprising. So looking just at the standalone PDs, so the creditworthiness of the companies, but also Taiwan, Ireland, and similar. On the highest PDs are the most credit risk. You've got Zimbabwe, Ukraine, Egypt, Bangladesh, and Pakistan, with levels up to, say, 20% on median. We're going to change the look a little bit, so you see some subtle differences in the shadings of the countries, as well as the top 5 lowest and top 5 highest PDs. What we've done here is we've incorporated a sovereign cap to the PD utilizing the country risk score. So for the countries that have a country risk that is worse than the PD of the companies, we basically floored the PD of that company. So you can't have a company that's more healthy than the business risk environment of that country. The most stark difference would be Argentina. You can see it's shaded in a dark red now down below. Previously, the median PD just on the companies themselves was about 4%. After the sovereign cap, it's up to 29%, straight up to the top of the list. Many of the other countries there look the same, but you have even much healthier countries, such as Germany and Italy and Spain, that are also impacted in perhaps more subtle ways. But all those countries that have changed their median PDs are noted with a little bit of shading. So you'll see white dots in some of these countries to note the difference there. I'd like to get Tim and Ritzen's thoughts on how you think about global risk. Obviously, you have exposure to many of these countries and more, and thinking about country risk and how that impacts your overall risk assessments.
Yeah, we'd look at it basically in 2 ways. One is kind of making sure that we'll look at our portfolio as a whole and make sure that the mix that we have between emerging and developed markets is we'll set internal targets and kind of just monitor that on an overall exposure. We do have subsidiary offices in 30, 40 countries, and the other thing that we'll do is every once in a while we are going into a country, especially in the mining or power project finance groups, where the deal that we're about to do is the first deal, and the biggest part of the underwriting is actually related to just the country due diligence. So every once in a while it's a new frontier for us also. But generally speaking, from a global perspective, what we do is kind of just monitor it and make sure that we don't have too much exposure in markets that we're not comfortable in yet. I will touch to one of the questions that came up as we were looking at the slide is, just looking at something like Canada and Australia and the probability there that's a lot, or that Canada and Australia are a little bit darker red than you would expect. That kind of goes back to what you talked about earlier in terms of this is the country risk score, and when you look at the companies there, they're very heavily focused actually in natural resources. So those companies' probabilities of default are actually going up, and that's something that we're dealing with. But you can see that in Canada and Australia. If you looked at that 3-4 years ago, it'd probably be a different shade of green.
Yeah, I definitely agree there. In Canada, we're seeing about 2% on median, probably no short relation to its energy exposure, and then Australia is about 1% on median, which probably reflects their commodity focus.
That's great. And this is an interesting topic to the audience. We've had several questions come in. One of them is regarding models and analysis that you do and how that might change, how the methodologies might change from region to region. Jim or Cat Financial, either one of you guys want to comment on that? Go ahead, Tim.
I'm sorry, I interrupted Jim. I apologize.
Okay,
Jim, go ahead.
Yeah, so we at S&P Capital IQ, so we try to have, as I mentioned earlier, sort of globally consistent models across. So we utilize things such as a country risk score or other standardized methods to account for local variability. Because we're very conscious that if you have a company in the U.S. and a company, say perhaps in Argentina, with the exact same financial statements, the risk of those companies is going to be quite different based upon the country that they do business in. So we apply filters such as this to that.
Yeah, I think that's a good point. This is Tim Logan. A couple other things that we have to look out for on our transactions, as Ritzen was mentioning, the countries themselves. So we will oftentimes look at higher risk countries and political risk insurance in concert with the financing structure. One of the other things that we have to look at is sanctions, as in the case of Russia in this point, as our operations try to deal with those issues has been a challenge as well.
Thank you. Thanks. So obviously, geography is a big challenge in counterparty analysis. Another very common challenge is the issue of public versus private company exposure. A lot of issues come up there. So the slide that you're going to see in front of you now is what we're calling the credit risk iceberg here, or the public-private iceberg. So essentially what we see is that for a small universe of companies, maybe 5,000 or 5 to 10,000, you have a lot of information from ratings and many other sources about their actual credit risk and your exposure to those companies. But most of the rest of the universe of companies and counterparties that people are exposed to are kind of hidden below the waterline. With public companies, obviously you get a lot of financial information from regulated filings, but still, there are only maybe 50 to 60,000 public companies globally, and there are plenty of challenges even, sort of translating from all the different jurisdictions as well. And then finally, again, the private company issue is huge, where we see, millions and millions of private counterparties where in many cases there's no publicly available data, which brings us to the next slide, which is around sort of the specific challenges that we see with private company data and private company assessment. Really, there are three main issues. One is acquisition, acquiring the data. So only in certain regulated industries, for example, insurance, where people are required to file publicly, or in certain tax jurisdictions in certain countries where people are required to file their financials with their taxes, can we actually gather the financials from public sources? Beyond that, there certainly are partnerships that we can be involved in to gather that data. But really, it kind of takes you to the next bucket for a lot of people, which is management. What you find is this sort of folder management system that a lot of people have is they get their PDF from their counterparty. If they're lucky, they get the financials. But then, you have a PDF file, so you have to store them in folder after folder, and data changes over the quarters. And what you really want to be able to do is have that information and ingest it into your system and be able to compare it side by side with other public and private companies to do peer comparison and other analysis. And finally, there's an issue of completeness, which is many times you're not going to get the same fields or the same set of information for different private companies. So what's the solution? Well, at S&P Capital IQ, we kind of address this in multiple ways. Certainly, we collect all the publicly available data. We try to collect all the publicly available data that we can. We enter into partnerships where it's feasible to bring in more data. And again, we provide a platform for loading your own private company data when you have counterparties that you get the financials from. And the final point, again, is around completeness, and that brings up a key challenge, which is having your models still be able to score the credit of your counterparties when you don't have all the financials. And Jim, I know you guys are working on some enhancements around that. Maybe you could speak for a minute about that.
Sure. So if you look at something like our fundamental probability default model, it might ideally look for 12 or 13 different ratio inputs, but especially in the private space, smaller private company, you're not going to have a lot of that. So we're making advances in the model such that you might need just the revenue number to get probability defaults, and you would think that reducing just one or two financial inputs would severely impact the performance of the model, but we're seeing even just a 15% decline in performance, which is not ideal, but it's still a pretty accurate gauge of risk based off of the size of the firm and the industry and sector that they operate within.
Thanks, Jim. And certainly, private companies do pose a lot of challenges, and we're hearing from a lot of people that gathering more information and being able to manage it and score their risks is a key part of it. Tim and Ritson, at Cat Financial, what is your perspective on private company exposures?
Right. I think we try to approach it from a relationship perspective in the fact that Cat Financial is ultimately a part of the debt capital structure of the business model. But we also bring a couple other things to the table for our customers in the form of Cat Financial is a part of or Caterpillar is a part of the operational functions of the business as we sell them Caterpillar equipment. And then we also have a direct relationship with our dealers as our dealers support the client operations and the maintenance and care of the equipment once it's sold. So from a relationship perspective, we're part of the debt capital structure, we're part of the operational structure, and then we also have the functional structure on the dealer side. So that three-pronged approach is the way we try to attack the customer needs.
Thanks a lot. So with that, we wanted to take a specific look into captive finance in general and some of the other trends in lending. But before we go into our panel part of that discussion, we have a final poll for the audience around shadow lending or shadow banking. So the role of shadow banking is, the first choice is good for the financial system, the second is a risk to the financial system, and the third option is an opportunity. And please fill in your responses to this, and we'll in a few seconds reveal the results and then move into the panel discussion on the role of shadow banking, captive finance. So this one, we have a pretty even set of responses between a risk and an opportunity, so kind of balanced against one another. I think the lowest answer is good for the financial system, which is maybe more of an absolute answer than the other two with risk and opportunity. I think that makes a lot of sense, and I think that's, from my perspective, correct. So with that, we would like to hear Caterpillar's insights into captive finance and the challenges and opportunities around that for them.
Yeah, this is Tim Logan. One of the things that we look at is why do you have a captive finance company? And if you think about the reasons for a captive finance company, as factories on par are usually in that 2 to 4 debt to equity, where your finance company may be 4 or 5, maybe even 6 times higher than that. And so it's a very good way for corporations, manufacturing corporations, to transfer the debt over to the captive finance source and take advantage of that leverage. So you're employing less costly equity in the structure.
Yeah, and I think the other thing is, which I'll add, Cat Financial obviously doesn't fall under shadow lending. We're always reporting, and we're actually rated separately from the parent entity. But if you look at the slide, you don't really tend to think of captive finance arms with hundreds of billions of dollars in assets sitting out there. You're always talking about the parent company in general, and that's really because if you look at the company overall, the captive finance group, in terms of revenue and profit, tends to be a very small portion of the larger manufacturing group and what they're selling. So it's a small part of the group of the parent overall. And I guess the other thing I'd add is we're also counter-cyclical in nature. So if you think about someone that's selling a piece of equipment, they'll get that revenue right away. From a captive finance arm, we're collecting interest revenue for the next 3, 4, 5 years. So that gets a little bit, we're basically spreading out some of the in a down environment, the captive finance group actually starts becoming a larger part of the profit number. But just from an overall perspective, it's a very small part of the larger operation.
Thanks a lot. And Jim, could you give us a deeper perspective on sort of trends in lending overall?
Sure. So what you see here is a couple charts. The one on the left speaks to bank credit to non-financial corporates. over a 5-year review, kind of starting with the period of the financial crisis. And you can see there's a relatively steep pullback in credit there. So a couple of trillion in the EU and a trillion in the US, and it really hasn't gone back up. Similarly, on the right-hand side, it's non-financial corporate bonds outstanding, so companies hitting the debt markets, perhaps as an alternative to that lending space. And especially in this friendly interest rate environment, the U.S. has really taken off, and I think if the chart continued to 2018, you'd see that continue to go up as companies sort of see the end of the good times for interest rates on the horizon. But really, this kind of speaks to the regulatory environment and how banks are, in some regards, discouraged from taking some of this exposure, and other avenues for corporates to find that funding. On the next slide, we'll look at the assets of non-bank financial intermediaries, courtesy of the Financial Stability Board, over a 10-year period, 2002 to 2012, and you can see really it's taken off, nearly tripling in assets, so up to 71 trillion as of 2012, and again, I'd expect this to continue its upward trend. And as a percentage of GDP, it's greater than 100%. It has been for quite a bit. And it's really kind of a testament to institutions outside of the traditional banks that are getting into this space. We regularly see and have conversations with corporates, captive finance institutions, private equity shops, hedge funds that are seeing potential source of profit, really picking up the slack of the banks really pulling back from this in certain ways.
Thanks a lot, Jim, and want to thank all of our panelists, Jim, Ritson, and Tim, for this insightful and timely discussion on counterparty analysis. At this point, I'd like to take the opportunity to ask our audience to click on the small red survey icon that's open our event survey and take just a minute or two to fill out the survey. We greatly appreciate your feedback, and at the same time, please continue to submit your questions for our panelists online. I would also like to point out that our next Credit Conversations webinar will occur on the 23rd of June. Registration and an overview is available at the web page listed on the screen below, and you will all be hearing about this as well. Thank you now for completing the survey, or for your intent to complete the survey as we continue with the Q&A session. Now we would like to take some time and answer the questions that have come in. And again, we won't be able to get to all the questions that have come in, but we will try to address as many as possible now and follow up with others afterwards. So first of all, I'm going to direct this at Jim first. How should private companies be ranked in an overall portfolio? And is there a way to give them a debt rating equivalence score?
So we see, obviously from some of the discussion today and some of the poll results and other outreach we've done, private companies are a large portion of the exposure. We saw the Iceberg earlier. It's a big part of everyone's portfolio. The approaches we laid out on the credit spectrum talk about ways to address that. So most of those private companies are not going to have market information available. They're not going to have credit ratings available. So you try to develop approaches to look and judge that credit risk. Specifically to the point about debt rating equivalent score, that's something where a credit scoring model would be most appropriate, because if you're looking really for that like-to-like comparison for rated and unrated entities, you have a quantitative approach or model that's been calibrated to perform like a rating might, but without having it available, it allows you really to kind of see apples to apples across those two universes. And in that case, you've got public companies, you've got private companies in your exposures. You might try to focus a little bit more on the private companies where you can, because there's less information available, so maybe they take a little bit extra thought and due diligence. But you can really kind of treat them equally, because you've got similar measures that look across the public and the private space.
Thanks, Jim. And We've gotten also several questions about the use of credit ratings in counterparty analysis in light of regulation and trends in general. I'll hand that over to Cat Financial first.
I think the question was, in general, how much we use those. We absolutely, when we have access to that research, are looking at it. But at the end of the day, our underwriting process is never, that's just one input. So we always have, whether it's an underwriter or our credit committee that's looking at the deal, they'll be using that as just one small piece of input. We're always approving deals through our own analysis. So it's a part of it. And every once in a while, when you have a transaction where you're lending to an entity and there's other entities involved, so some of the questions that we are seeing coming in have to do with, if you have hedge providers, we do look at not just the rating for the person that we're lending to, but what's the insurance rating for the company that's the insurer behind them. So for something like that, when it's one aspect of the counterparty analysis and not someone that we're looking into deep, we may go to our borrower and say things like, we would require and ask that your insurance company, for example, have a minimum rating of A or whatever it is.
Yeah, and I'll complement that where we talked about this is Jim Elder from S&P Capital IQ. We talked about best practices in light of that credit spectrum, saying take measures from each part of the family. So the qualitative approaches, the quantitative approaches, and the market approaches. And I'm not a ratings analyst, but I know that they follow that approach as well. So they'll, in conducting their ratings analysis, they're also looking to the equity and the CDS markets as part of their process. So really these sort of best practices apply for credit analysts inside corporations. They apply for ratings analysts, and really everyone is best advised to look to multiple methods because there might be some piece of information in another market or another data source that can give you a different perspective on the risk of that entity.
Thanks, Jim, and thanks, Ritzen. Several people in the audience have asked questions around hedging credit risk with CDS or other financial instruments. Tim or Ritzen, do you guys have? Can you give us some insights in Caterpillar's or Cat Financial's practice around this?
We look more at a global portfolio view, so a CDS contract is something outside of what we would normally practice.
And I guess the other thing we'll add is, if we're looking at something like that, there are loan agreements where we would work with the borrower and ask them to hedge some of their risks. But in general, we're not going out and using default swaps or derivatives to hedge our counterparty risk. I should say our individual counterparty on individual counterparties.
Got it. That makes sense. And Jim, in terms of pricing risk or evaluating risk, maybe you could provide us some insights on that as well, ways to do that.
Sure. Yeah. So judges of credit risk, CDS markets are a good lens for that to think about what the risk of the entity is as part of your overall process of thinking about how should I price a loan or a certain deal. We also have ways to we've recently developed corporate yield curves, so thinking about pricing of instruments by rating category and sector at tenors from 3 months to 30 years. So as you're looking at exposure, if you have a judge for the credit risk of that, so where it might fall from most risky to most risky, combining that with information from the CDS markets and from the bond markets and the loan markets, thinking about where I should price this exposure, you can kind of combine those metrics and come up with sort of how the market might view the risk of that loan from a pricing perspective.
Thanks. And several people in the audience found the country credit risk heat map quite interesting and pointed out specific countries that might have seemed higher or lower than they would have expected. For example, from my perspective, I'm always a little bit surprised that the United States isn't, the darkest green. Could you give us some insights into that, Jim?
Sure. So keen observations, especially given all the different ranges of colors on this slide. Some of the more developed markets, I guess I'll remind that this is based off of the PD model market signals, which looks to the equity markets. So a market like the U.S. Has very robust equity markets, or the most robust. Similarly, a country like the U.K. Would have similarly robust markets. And what happens there is you've got more companies that are traded, so you've got a wider range of firms. So certainly you have the largest firms that would be traded in those markets, but you also have a lot of smaller public companies which, by sort of nature of assessing credit risk, all things equal, a smaller company is going to have more risk. So you might look at Ireland and France and think, well, why are those perhaps more risky than the UK, or why are they less risky than the US? And part of it is going to be the overall breadth of firms there. So if you were to control for size and say, I'm only going to take the largest companies in those markets, you might get a slightly different picture. But it's something to think about. You've always got to kind of look behind the data. So more data is better, but there's always a different lens to take to it. So I wouldn't say that, overall the U.S. is more risky than certain other areas. But when you look about the public equity markets and what firms you can judge for credit risk, you've got more information available, which is going to change those median levels.
Thanks, Jim. So another question is around infrastructure, and certainly infrastructure is a big topic, and improving infrastructure is a big topic for the United States as well as many other countries. It's certainly a focus for S&P Capital IQ in helping to understand the risks and facilitate infrastructure development. But obviously, Ritson Caterpillar must have very strong involvement with infrastructure development as well. Could you give us some thoughts?
Yeah, I think there's two parts to that. One, and the easy answer that most people think of to that is, when you're building out infrastructure, you're going to use our equipment to do it, so that helps. But one of the reasons that Caterpillar and a lot of U.S. manufacturers in general focus on that here is because we're thinking about how we actually not just make the equipment, but export that equipment out. So if Caterpillar last year, the majority of the equipment, over 50% of the equipment that we made in the U.S. actually left to go to other countries. And just as an example, we manufacture solar turbines. And when I say turbines, if you think of like the bottom of that rocket ship, it's large, massive pieces of equipment. We manufacture them in California, but the ports in California can't actually handle that volume. So we have to ship it from California down to Texas and use ports in Texas. So when manufacturers are talking about that, it plays a big role in just the costs that are added to it. So that's one of the big reasons that we're always talking about infrastructure and focused on it too.
Thanks a lot. And at this point, we've run out of time for Q&A. We'd like to thank you again for your time, and we look forward to your joining us on June the 23rd to continue the conversation on credit and counterparty assessment. Once again, thank you for joining us, and have a nice day.